So when you find a company to invest in, you have spent hours and hours researching the company, followed it for many weeks, months, or even years, waiting patiently for the price to reach a level you're happy to pay. And finally, the time arrives. The valuation has reached your first buy price. Well, do you know how much you are going to allocate as a portion of your portfolio to this investment? Portfolio management is something that is wildly different across every investor. Each person has their own preferences. And in my opinion, portfolio management is pretty easy to understand, but really difficult to implement. Today, I'll discuss portfolio management strategy, and hopefully you will have a better idea how to think about your portfolio structure. All right, now firstly, let me just set the tone of this video. See, I'm coming at this topic from a long-term value investor that likes to see my investments grow bigger and bigger over many years. Nothing in this video is going to sit well for investors that don't do a lot of research. And what I mean is that for most people, buying and selling is more about fear and FOMO than it is about the fundamentals. Now, ARK Invest is a great example. In 2020, assets under management for ARK Invest grew 11 times. Now, ARK Invest, their portfolio has been performing really well, and people from all over the world were piling money into this winning formula. Now, I'm not here to debate whether this is a good idea or not, but most investors were jumping into this because of this strong emotion called FOMO, which is the fear of missing out. It is a real thing and something that drives a lot of stock market behavior. Now, as a value investor, I like to find value anywhere. It doesn't mean I don't like tech stocks or fast growth stocks or anything like that. I just don't like overpaying for any investment. If I think something is overpriced, I'm not going to invest. So because of that, my portfolio management involves a lot of waiting around, especially the last 12 months, to invest in the things that I want. But one day, hopefully soon, the companies that I like are going to be in my range. So I want to think about how I want to organize my portfolio to maximize my returns. So essentially, I'm balancing between the idea of diversification and concentration in my best ideas. Now, if I have one great idea that I am super confident with, well, I could put all 100% of my portfolio in this idea and sit back and just see what happens. Now, if it is my best idea and I think it will give me the best return, then this would be the best way to get the biggest return of my money. If I think it is going to go up, say 100x in the next 15 years, well, I just should put everything into it. But the problem is I'm not strong enough in my idea to ever do that. I'll always have this little doubt in my mind thinking that, what if the management team are lying and it's all a big act? What if there is fraud in the financial statements? What if all the key employees die in a freak bus crash? What if something I just can't predict comes along and changes the entire industry? Just something that I can't foresee. Okay, so for me, having all my money in one idea is just a little too much for me personally. Now, the best investors in the world, like Manish Pabrai, Lee Lu, Norbert Lu, Charlie Munger, and a handful of others have less than 10 investments in total. Some of them have only 2 investments. So somewhere around 10 maybe is starting to feel about right for me. Put as much money into a handful of great ideas. A little diversification, but not too much. Also, they only invest in companies that have a great chance of going up, say 10x or 100x in the next decade. No point investing in something that is going to just double or triple and that's it. Now, on the other side of this argument, there are other very famous, highly successful investors that have hundreds of investments in their portfolios. Peter Lynch is the one that comes to mind first. Peter Lynch is one of my favorite investors of all time, and he ran the Magellan Fund back in the 1980s. Now, at times, he had over 1,000 investments, yet the fund performed just about the best of anyone in the entire world, better than Warren Buffett during the same period. And speaking of Warren Buffett, even in the Berkshire Hathaway portfolio, they have over 50 stocks. So there are obviously many different ways to manage a portfolio successfully. Now, I've even heard Mark Cuban say before that diversification is for idiots, but that's unfair considering Peter Lynch absolutely killed it for over a decade with a very diversified portfolio. So like I said, there's just many opinions on this one. I don't know what is the best, but I think 10 good ideas feels like it would be easier to manage and keep up to date with. I have no idea how Peter Lynch kept up to date with over 1,000 companies. Now, my portfolio doesn't look like this right now, but in an ideal world, I would have 10 companies that all have similar outlooks and potential. I would then have an even split amongst them and sit back and go get a different hobby. But that's not how it works. Not all investments are made equal. Also, another really important point is we all evolve as investors. For example, for the last few years, actually about the last decade, I've been looking for great companies at good prices. It didn't matter how big they already were. For example, I hold investments at the moment in Alphabet, Facebook, Skyworks, Prudential, Bank of America, Berkshire Hathaway. These are all seriously incredible companies that have been giving me great returns. I'll probably still be holding these in 10 years' time. But I have evolved as an investor. I have read more books and listened to more smart people. My ideas are evolving. I think one of the biggest influences on me recently is the book 100 Baggers by Christopher Mayer, and that has altered my strategy. I think my time and energy is better spent looking for 100 baggers, so that's stocks that can go up 100 times in the next decade or two. Then just recently, Mohnish Pabrai, one of my favorite investors, came out with a lecture that talked about a similar idea, looking for companies that can get these huge returns. So both Christopher Mayer and Mohnish Pabrai agree that to find these companies, I need to find high quality companies that are growing and what Mohnish Pabrai would say are spawning. So spawning off different ideas and different avenues for making more money. And that are most likely going to be under $500 million in market size. This seems very logical to me, and after plenty of thinking and researching, I had changed my thoughts about what I would invest in moving forward. I would now prefer smaller cap companies that I think can reach 50 billion or 100 billion in size. So from 2021 and onwards, I plan to not invest in larger cap companies. Maybe I would consider a $20 billion as an absolute maximum, but I have to be really impressed. So look, no more Googles and Facebooks or even Amazon. Now in saying that, that hurts my brain a little because if Amazon was to say fall to $2,000, that would be very, very difficult to refuse. It would be like I'm missing out on free money. So I even know my emotions are going to be hard to control if everything is on sale in a market correction. So do you see how hard it can be? I could make myself invest only in companies under $1 billion in market cap because I made this strict rule with myself. But then Amazon, a company I've been following for a decade now, finally reaches a bargain price. Will I be able to resist? Probably not. I don't know. My plan at the moment is I'll just have to wait and see and keep learning and keep evolving. So coming up with a strategy is really easy, but following it is just incredibly difficult. So it all depends about how confident I am with an idea. Not all investment ideas I have the same conviction on. I also sometimes get emotional about an investment that I think is a sure thing. I have researched it for months and I just think it makes total sense. So this is how I approach it and how I plan to approach it moving forward. I'm going to have 3 buy prices. For a company I am very confident in, first buy price for an investment is I'm using a discount rate of about 20%. That's from my intrinsic value calculator. You can get a free copy of it in the description. That's how I calculate this. And I'd like that first order to be about 5% of my portfolio. The second buy price, I'm getting a better discount rate, so it's going to be a cheaper price. And I bump that up to about the same amount, so it's going to jump up to about 10% of my overall portfolio. And then for my third buy price, this is a discount rate of about 30%. Now this is a really big margin of safety, and this is a really low price. If I ever got this, I really have to probably double down. So I would bump it up now to 20% of my overall portfolio. It would make a big chunk of it. Now that was for a company that I'm really confident in, but for a company that I think is a sure thing with practically no downside and big upside potential. It ticks all my boxes and I think I'm an idiot for not finding this investment earlier. In that situation, well, I want to buy, still have 3 buy prices. The first one is still going to be 5%. But if I do get my second buy price, well, I'm actually going to double the amount that I'm putting into this company. And if I do ever get my third buy price for this company, well, I'm just going to throw whatever I have available in it. If it's raining gold, I want to get the bathtub out and not just a little cup. To find a company that fits into this second strategy, I want to set a date in my calendar for about 6 months' time. Because if in 6 months' time, I still think this is by far my best idea, well, I will follow my buying strategy. See, sometimes what might happen is that I am seeing the investment with greed and not with logic. And the best way that I know how to stop emotions interfering with my decision making is to just chill out and take some time. If in 6 months it's still a no-brainer, well, it's probably a no-brainer and I'll go for it. See, at least I've had then some time to think about it and let my initial emotions subside a bit. The next big question here is, what about trimming positions? The big super investors often do this. Let's say one of my investments goes crazy, up 5x in 2 years. Now it is way bigger part of my portfolio and it makes up, I don't know, 70% or something like that. Well, selling is just super difficult. Now I like to follow Peter Lynch here when he said, look, don't cut your flowers to water your weeds. So what I do is follow the coffee can strategy for investing within reason. And the best thing to do is to pretend I put the share certificates in a coffee can and hide the coffee can in the back of a cupboard and just forget about it. Just because the company makes up 70% of my portfolio doesn't mean I should sell it for any reason. It's a great company, keep it going. Now this is also a low turnover approach and is not only great at keeping fees and taxes to a minimum, it also gives me the chance to take emotion out of the decision. Because seriously, fear often gets us to sell and that's often the last thing we should do. Now after saying all that, there is a time when I would sell my great ideas. Look, maybe I'm thinking about this incorrectly, but what I would do is sell an entire position if the valuation just gets silly. For example, if the stock price goes 2 times past what I think fair value is, well, okay, maybe that's okay. Maybe I made a few mistakes in my future assumptions. But if it goes 3 times past my fair value of the company, well, my future returns now are probably worse than just cash. So that is when I have to seriously think about selling. Look, it's a nice problem to have, but that's how I think about it at the moment. It happened to me with Apple in 2020. The value went to about 2.8 times my fair value calculation, and I sold the entire position. Look, maybe I was wrong, but the money will hopefully go into a far more lucrative investment, especially when I put it into a company that is amazing and only at $500 million in size. That upside is going to be far better. Well, I hope. Investing is more psychology than it is anything else. Level of intellect doesn't mean much in my opinion. The difference between the best and everyone else is the strength of their mind. So that is what I'm working on, and I'm far from perfect, and I acknowledge that I'm affected by fear and FOMO just like everyone else. And I'm just learning to control it, and that is what I think is the key to being successful over the long term. I'll be continuing to evolve as an investor, and honestly, YouTube has been incredible for growing as an investor. I've had to study hard and get my thoughts clearly laid out just to make one of these videos. That extra thinking power has made me a far better investor. And I hope people do actually enjoy my content. I don't take this lightly. I put my best effort into every video. And thanks for all the feedback and the kind words. It is really cool to see that people just like me are out there in the world and we can meet through these videos. So I hope you got something out of this one. Thanks for staying to the end, and I will see you in the next video.